Our knowledge series on corporate tax in UAE. The video covers following important matters: motive behind the corporate tax regime, requirements from the OECD, key principles of the corporate tax regime, corporate tax implementation, legislation and scope, nature of corporate tax and administration, national level taxation and history, corporate tax rate and registration. General principles for corporate taxation in UAE. Introduction. Following the implementation of indirect taxation including excise tax in 2017 and value-added tax in 2018, UAE has introduced a corporate tax regime that applies to tax periods starting on or after June 1, 2023. Motive behind the corporate tax regime. UAE introduced corporate tax regime prompted by the requirements of OECD. Corporate tax regime implemented by the UAE is simplified and does not create overburden for taxable persons to observe multiple levels of compliances. The UAE is committed to preventing harmful tax practices and meeting international standards for tax transparency. The objective of such corporate tax regime is to attract and retain the businesses. Requirements from the OECD. Organization for European Economic Cooperation (OEEC) has developed the Organization for Economic Cooperation and Development (OECD), which is an international organization formed to help rebuild Europe after World War II. The OECD improves policy making and works to foster collaboration by and between countries to generate opportunity, prosperity, equality and well-being. OECD works on establishing evidence-based international standards and finding solutions to a range of economic, social and environmental challenges together with policymakers, governments and citizens. From fighting international tax evasion and improving economic performance and creating jobs to fostering strong education, the OECD provides a unique forum and knowledge hub for exchange of experiences, data and analysis, best practice sharing, and advice on international standard and setting and public policies. In conjunction with the Group of 20, G20, the OECD's Base Erosion and Profit Shifting Project, BEPS, has been a substantial exercise, using base erosion and profit shifting tools to set up an international framework to combat tax avoidance by multinational enterprises, MNEs. These tools are tax planning and setting strategies used by MNEs to exploit gaps in tax rules to avoid paying tax. The objective of BEPS is to prevent this kind of tax avoidance. Developments from the final BEPS report in 2015 continue. Including the UAE, there are more than 100 countries who have joined the inclusive framework on BEPS. This commits to a two-pillar plan to ensure that MNEs are fairly taxed wherever in the world they operate and to reform international taxation. Pillar 2 imposes a global minimum tax of 15% on MNEs with global revenue of more than €750 million, where groups have an effective tax rate below the minimum in any jurisdiction. They will be required to pay top-up tax in the jurisdiction of their head office. The UAE is a member of the OECD BEPS inclusive framework and is not a member of the OECD itself. UAE is committed to addressing the challenges faced by tax jurisdictions internationally. The introduction of a corporate tax regime helps to provide the UAE with a framework to implement the Pillar 2 rules. Until the Pillar 2 rules are implemented by the UAE, MNEs will be subject to CT under the standard UAE corporate tax regime. Key principles of the corporate tax regime. Certainty and simplicity. Tax rules should be clear and simple, so that businesses understand their obligations and make the right decisions, and compliance costs are minimized. Flexibility and alignment. Flexibility and alignment with modern business practice. Tax systems need to be dynamic to keep pace with changing economic and social circumstances. Transparency. Clear guidance and public communication are important to ensure businesses understand their obligations and entitlements, and to ensure the fair and effective enforcement of the UAE corporate tax rules. Neutrality and equity. Tax rules should be neutral and equitable between different types and forms of businesses. For this and other reasons, the UAE corporate tax regime applies to all forms of commercial activities and businesses alike and covers all types of profits and income, with specific rules to address possible inequalities and arbitrage opportunities. Corporate tax implementation and legislation. Corporate tax regime was implemented via Decree Law No. 47, the Corporate Tax Law, enacted in 2022. The corporate tax law sets out the general principles of corporate tax, including its scope, definitions, and powers to tax. Further legislation, including Federal Decree Law No. 28 of 2022 and Cabinet Decision No. 74 of 2023 on tax procedures, establish detailed rules in respect of compliance. These are referred to as the Tax Procedures Law and the Tax Procedures Regulations, respectively. Nature of corporate tax and administration. Corporate tax in the UAE is monitored by the Federal Tax Authority, or FTA. The authority was first established in 2016 to manage VAT. It is also responsible for the collection, administration, and enforcement of the other taxes in the UAE. National level taxation and history. The UAE corporate tax regime is a federal tax covering all the 7 emirates of the UAE. Prior to the implementation of the federal regime, the individual emirates had their own laws on corporate tax. In practice, these laws affected limited situations. In particular, they were applied only in relation to entities which were either branches of foreign banks or foreign producers of oil and gas operating in an emirate. Implementation and scope. Corporate tax is defined as the tax imposed by this decree law on juridical persons and business income. Article 1 of the Corporate Tax Law define business as any activity conducted regularly, on an ongoing and independent basis by any person and in any location, such as industrial, commercial, agricultural, vocational, professional, service or excavation activities or any other activity related to the use of tangible or intangible properties, and business activity as any transaction or activity, or series of transactions or series of activities conducted by a person in the course of its business. The UAE corporate tax rates. 0% up to taxable income of AED 375,000. 9% over taxable income of AED 375,000. Registration. A taxable person must register with the authority and obtain a tax registration number, except in circumstances prescribed by the authority in Ministerial Decision No. 43 of 2023 as mentioned in Article 51.1 of the Corporate Tax Law. Article 51.3 of the Corporate Tax Law mentions that the authority may enforce registration of a business subject to corporate tax who fails to register. Penalties may also be imposed. This ends our video session. Subscribe to our channel and click on notification icon to stay tuned to the series of valuable material that will cover all aspects of the UAE corporate tax. Our partner is available for free consultation who is holder of FTA approved UAE corporate tax qualification. Visit finexcel.ae. Navigate to our clients and testimonials webpage to see more clients' review on our services and our major clientele. Contact us for more details. Finexcel. We create value that matters.